Hi, and welcome to Forms of Business Structure. In this course, we're going to walk through the most common types of business structures that you're likely to see as a credit analyst. You'll learn what they are, the advantages and disadvantages of each, including understanding the liability, rights, and restrictions of each structure as well. Finally, you'll gain an understanding of how the legal structure of a company affects the lending process and how it may impact any credit decisions made. There are many types of business structures, and they vary by country. However, as you can see, several of them are born from two primary structures: partnerships and corporations. Sole proprietorships are another common type of business structure used for small businesses. Two other business structures warrant attention as they're common in financing situations: limited liability companies and franchises. A sole proprietorship is the simplest form of business ownership. As the name implies, the business is owned and managed by one person, and it begins and ends at the will of the owner or upon the owner's death. From a legal perspective, a sole proprietorship is indistinguishable from the owner. The business may be operated in the owner's own name or under a trade name, where the owner may indicate DBA or doing business as. There are advantages and disadvantages to sole proprietorships. A sole proprietorship can be advantageous for many reasons. First, it's the easiest and simplest form of business organization to use. It's free of some of the regulations and formalities of other forms of business structure. Also, due to its simplicity and flexibility, it's particularly suitable for small businesses. The owner retains 100% of after-tax profits, as there's no separation between the individual and the business. All profits flow through to and are reported on the owner's personal tax return. The main disadvantage of a sole proprietorship is that liability is not limited to claims on the assets of the business, since the proprietor is fully personally liable for the business's obligations. The owner's equity in personal assets, such as his or her home, can be used to make good on any financial obligations that the owner may assume in the course of carrying on the business. From a creditor's perspective, this can be seen as advantageous, as a separate guarantee for repayment from the owner isn't really necessary. Also, for a sole proprietorship, capital is limited to what the owner can provide or borrow. The proprietor can't issue shares in the business to others as a means of raising money. If something were to affect the owner's ability to manage the business, creditors may have concerns about recovering money lent. In the case of an extended illness, business operations could be seriously disrupted. In some instances, other family members may have the capacity to operate the business if the proprietor becomes ill. The availability of such backup support or some type of business interruption insurance should be considered when granting credit to proprietorships. Finally, the proprietor must make decisions in all areas of the business: production, sales, finance, and personnel. And these decisions may be particularly difficult for a proprietor with limited background or limited knowledge in the specific problem area. The pressure and time constraints imposed on a sole proprietorship may make it difficult for the individual to properly monitor and manage all aspects of the business operations. Options for the owner include hiring outside help or obtaining professional advice on specific aspects of the business's operation. It's therefore important to consider the owner's business experience, operational plans, and growth aspirations to assess the future viability of the business. Let's consider the different types of business where sole proprietorships are typically found. You'll see that these tend to be businesses that can be managed by one person with a limited number of employees, if any at all. Perhaps what may also attract your attention is that they tend to be lower risk businesses. That is to say, these are businesses with a much lower risk of being sued. Remember that the owner's personal assets are tied to the business. There's no legal separation. For that reason, it's important for a business owner to consider the right structure for the type of business he or she wants to operate.